we looked at all those short sections that came from the actual textbook, looking at different forms of insurance. Now we're changing focus slightly because we're moving more towards the retention part of things. Right at the beginning in chapter 1, we spoke about risk management as being risk financing and risk control. We then focused on the risk financing, which was taking resources and trying to mitigate risk as much as possible. Okay, remember the risk financing requires a cost. So you as the business is going to have to incur a cost in order to reduce the risk. Risk control doesn't involve finance, it involves other. So things like a sign-off or authorization. Okay, so are you involved with authorizing certain payments to be processed at your company?
No.
Not at all. Okay, so
only management level.
Management. Okay, so if the managers are responsible for authorizing certain payments, do those managers need approval?
It's just 2 sign-offs for payment.
Yes, good. Okay, so 2 sign-offs are required for the payment. So one individual wouldn't be able to make a payment. Do you agree?
Yes.
Is that control or financing?
Control.
That's control, because it's going to avoid maybe potential fraud and corruption or payments that aren't being made for specific things that the business is requiring.
Yes.
Okay, good. So in chapter 1, we did touch on this concept, which was the retention. Retention is focusing on keeping the risk within the business and not financing it or financing it, depending on the situation. So the focus here in chapter 13 is self-funding and some of its advantages. Right, so in other words, why would keeping the risk be a good idea? Or why would self-funding the risk be a good idea? That's what we're trying to focus on here. When looking at study unit 13 onwards, all of these study unit chapters are covered in the UNISA study guide and not in the actual textbook that they've prescribed for this module. So you do need to refer to the content in the actual study guide, because that's what they're going to be testing in the actual exam. And having looked at some older past papers, you'll see that the focus in the longer questions, the written questions, generally come from study unit 13 onwards, because UNISA's testing their own material. They do test the textbook and they test all the other theory, generally in the multiple choice, and they normally leave the longer questions for these topics. So self-funding could be one of the topics that you would be asked to write about in the actual written long questions. So the first thing that we need to establish is, what is self-funding? So here's a question for you to consider. Why would companies consider self-funding? What are some benefits for the debate? Okay, so for self-funding or against self-funding. Just to remember to keep this in mind, keeping funds available helps us to cater for losses that arise from various risks. Okay, so when self-funding a specific risk, we're looking at setting aside funds that will be available for use in the event of loss. So why would a company want to consider self-funding their risk? Any idea?
Maybe they think about saving money.
Okay, how would self-funding be a form of saving? Just explain a bit more.
If, maybe if you pay like your premiums towards your insurance,
yes,
it would be too high. But if you retain the money with you, you can earn interest on the money. Maybe they look at it from that point of view.
Very good. Okay, so here's a question. When you pay your premium towards your car insurance, if you aren't in an accident, do you get any of the premiums back?
No.
Assuming you don't have any of those bonuses that some of the insurers do offer.
No, you don't.
No, you wouldn't, yes. Okay, so assuming that we don't get those cashback bonuses and those types of rewards, okay, for not claiming, okay, would those premiums be kept within the business? No, they wouldn't, because those premiums would be paid to an external party for taking on the risk. Right, because are we transferring or retaining the risk?
Retaining.
We're retaining the risk, exactly. So if we retain the risk, we're going to be keeping the premiums.
Yes.
Okay, so self-funding assists with what you've mentioned. Okay, saving those premiums because those premiums can actually grow, and who receives the benefits?
The company.
The business, exactly. Good. Right, what would be some disadvantages? Okay, points against self-funding.
What if the risk is too large and you're unable to fund it yourself?
Very good. Okay, so the loss can actually be too much in terms of, let's say, a severe loss. Okay, the loss is high in terms of the monetary value. So if we're talking about car insurance, the car is a write-off. You've chosen to self-fund the damages of your vehicle. Okay, would you have enough finance in the actual, let's say, savings for buying a brand new vehicle?
No, you wouldn't.
Possibly not. Okay, unless you've self-funded this for several years.
Yeah.
Okay, so self-funding has its advantages and disadvantages. There are different types of losses that we would be comfortable self-funding. Okay, so do you agree a complete write-off for a vehicle would be a very, very severe loss?
Yes.
Okay, a scratch to the side of the car wouldn't be as bad to deal with.
Yes.
Okay, so would you self-fund, let's say, a crack in the windscreen?
Yes.
Yeah, that's something that you'd be able to fund in terms of raising the capital or saving the capital to fix the windscreen. But let's say buying the new vehicle because the entire vehicle has been written off in a car accident would be a very different scenario. The loss could be severe. Okay, so when looking at self-funding, these are the different groups that they classify losses into. Okay, the impact of the losses on the company. That's what we're looking at. Type 1 losses. Losses arising from risks that produce aggregate, inverted commas, constant yearly small difference between the aggregate and predicted. Okay, so we're looking at this as what? Predictable or unpredictable?
Predictable.
Predictable. Right, so these are things that we know are going to occur within the business. Right, an example could be, let's say we're running a retailer. Is a retailer going to suffer some losses in terms of theft?
Yes.
Yes, they would. Okay, so losses arising from risks that produce aggregate constant meaning predictable, okay, inverted commas, okay, yearly costs. Right, so we know that retailers are going to expect a certain amount of either theft or damages of stock that they're selling. Do you agree?
Yes.
And that's predictable. Okay, so they'll have an estimate, maybe 1% or 0.5% of a particular item is going to be a loss, okay, or suffer, or will be suffering a particular loss. Type 2, losses arising from risk that produce aggregate excess yearly costs above those associated with the first loss. Costs can be absorbed over a 12-month period. Okay, so example here, if we look at the retailer, can the retailer be broken into by burglars?
Yes.
Okay, is that going to put them out of business?
No.
No, it won't, but it's going to take them maybe 12 months to recover from that break-in.
Yes.
Alright, so if someone comes into the business and steals lots of stock, the business can still operate and continue, but they need to recover all those losses, and that could take some time. Okay, so do you agree a business would predict or estimate type 1 losses in the form of customers maybe stealing or damaging stock within the business? Okay, so maybe an item falls off the shelf and is damaged and cannot be sold. Would that be a type 1 or type 2 loss?
Type 1.
Type 1. Okay, type 2 would be a burglary, okay, where someone steals from the factory and the business needs to recover that. It's excess, so on top of what we've expected. Okay, type 3 losses are losses exceeding type 1 and type 2, meaning these are events that are going to be more, let's say, detrimental to the business because it will have the most impact on that particular business. Right, so type 1, those are things that we expect that's going to happen in terms of damages, loss, or other. Type 2, things that can occur that's a bit more problematic than type 1. And type 3, those are losses that exceed both type 1 and type 2. Right, so these are losses that put you out of business. Okay, so exceeding in terms of type 1 and type 2. Okay, so type 3 losses could be more catastrophic. So something that is more impactful on the business. So an earthquake. Would an earthquake be a type 1 or type 2 loss? Or a type 3 loss?
I think it'll be a type 3.
Type 3. Okay, hurricane?
3.
Also type 3. War and riots?
War and riots. Type 2.
Type 3 as well. It's exceeding
Type
1
3.
and 2. Okay, okay, maybe because of the environment that we're in. So obviously in our environment, we're actually quite used to strikes happening quite frequently, right?
Yes.
Okay, they tend to happen more often than not in our labor market. Okay, so in the South African labor market, we tend to have strikes quite often in different sectors. So perhaps you could assign that to type 2 if those strikes directly affected your employees, okay, as part of your operations. But if it was a broader, let's say, riot or strike or even war, okay, conflict, then that'll be seen more as a type 3. So type 2 would be your employees striking or protesting for better benefits. Type 3 would be the country suffering from, let's say, war or conflict within the country. Okay, and that's going to be something excessive. Does that make sense? There's a slight difference between the two.
Yeah.
Okay, but just remember its severity. So type 1 is low, type 2 is a bit more severe, type 3 is the worst. Okay, you don't want type 3 losses to occur because they're exceeding type 1 and type 2. Okay, so if we're looking at self-funding, which losses would you be comfortable self-funding?
1 and 2.
Why do you say 1 and 2?
Because it's not as severe as 3. I think
correct.
3.
But we need to also consider the insurer. Are you going to be able to take out insurance for type 1 and type 2?
I don't think type 1.
No, type 1 and type 2 you can take out insurance. Because can you take out insurance for theft?
You can.
You can. All right. For type 2?
Type 2 as
fire?
well, but I
Let's
think
talk
all
about
of
fire.
them.
Would fire be type 2 or type 1 or type 3?
Type 3.
Type 2?
Type 2,
Yeah,
okay.
a fire would be type 2 because it's excess yearly costs that you would recover from maybe in 12 months. Okay, well, maybe I should say this. How big is the fire, Melanie?
Yeah.
Okay, because the fire could be massive and that will be type 3.
Yeah.
Okay, if the fire just destroys one room in the factory, then that will be type 2, yeah.
Type 2.
Okay, so it does depend on the severity as well, definitely. Okay, but my question to you was, is an insurer going to want to insure type 1, type 2, or type 3?
I think 3.
Okay, the insurer would probably be looking at type 1 and type 2. Why? Because they're predictable and they're measurable. Okay, can we measure a war or a riot or a natural disaster?
No, you can't.
No, you can't. Okay, so when it comes to self-funding, yes, we can self-fund type 1 and type 2 very easily. But do you agree type 1 and type 2 can be covered in terms of insurance, where we can transfer the risks to our insurer?
Yes.
Okay, can we self-fund type 3 losses? You can.
No,
it's going to be
can't.
difficult to cover those losses. But would you have been able to take out insurance on those losses?
Type 3.
Would you have been able to take out insurance for an earthquake?
No.
No. Alright, so do you see how we need to weigh up the pros and the cons in terms of self-funding? Things that we can self-fund and things that we can't. But we also need to think about things that we can insure and things that we can't.
Yeah.
Okay, so if an earthquake damages our property, so for example, we felt those massive tremors not so long ago. There was like a 6-point-something magnitude earthquake in Botswana, that was a neighboring country, and those tremors were felt in this country. If there were damages from that earthquake, would the insurance company have covered those losses?
No.
No, they wouldn't. Okay, because it would have been seen as part of a natural disaster.
Yeah.
Alright, so do you agree self-funding would then have had to have been part of your, let's say, business? Because if, let's say if windows were broken during that tremor, could you have claimed for that as part of
No.
your house owner's insurance?
No, you can't.
No, you wouldn't. So that would have been something that you would have to have paid for.
Okay.
Okay, does that make sense?
Yes, it does.
Alright, so 4 questions actually for you to consider here. Advantages and disadvantages of self-funding. Reducing insurance costs. Is there a benefit or a disadvantage here?
Benefit.
Yes. Okay, so the benefit is what?
You save on the premiums.
Correct. Okay, you keep your premiums, you save on the premiums. But what is the disadvantage?
Sometimes the extent of the damage is more than what you have saved.
Correct. Okay, and you're going to also have to keep more risk. Do you agree?
Yes.
Alright, so good example here. How can you reduce the insurance costs on your car insurance?
Have no claims.
Okay, no claims, yes. But if we're going to be paying insurance, okay, so you're paying a premium. How can you reduce that premium?
Increase your excess.
Correct. Okay, what is the excess viewed as?
Um,
The self-funding portion, do you agree?
yes.
Okay, so that's an example of self-funding. Your excess is your portion of the loss that you would have to pay for that you're going to self-fund. Okay, so if I reduce the insurance cost by reducing the premium, yes, the benefit is a saving monthly in terms of costs toward the policy, but the disadvantage would be an increased excess.
Yeah.
Okay, so it's basically a scale. That's basically what I'm trying to get at in terms of what do we self-fund, okay, or retain. Okay, so earlier we had this diagram, retention or transfer. That's what we're looking at. We're looking at how much do we retain and how much do we transfer. It's always like that, okay, because there's a portion, it's an allocation. Okay, so Melanie, is your excess high or low on your vehicle?
Low. It's low.
Okay, so it's a low excess. That means you're probably paying a slightly higher premium.
Yes.
Okay, so in terms of self-funding, are you self-funding that risk? Yes, but only by a very small portion.
Yes.
Okay, because majority of it is transferred to the insurer. So if you're in an accident, okay, they're going to cover the majority of that loss. Does that make sense?
Yes.
Okay, great. Improving cash flow. What's the benefit or disadvantage there?
Improving your cash flow, again, you save on your premiums, but if the risk is high and the damages are high, then it's not good for your cash flow.
Okay, good. Yes. So when there is a claim, and if it's self-funded, you're claiming from yourself, basically. All right. So your cash flow will be negative when you claim in the future if you've self-funded a particular loss, but the cash flow in the present or leading up to the actual loss is going to be positive because all those premiums are kept within the business. Those premiums aren't being paid to an insurer.
Yes.
Okay. And then the last point, providing an opportunity to earn investment income. Benefit and disadvantage here?
The money that you're saving on your premiums, you can invest it and earn interest on it.
Yes. Okay, so who owns those premiums?
The business.
The insurer, yes. Okay, if you're self-funding your loss in terms of vehicle or household expenditure and so on, okay, who gets the benefit of those premiums?
The business.
The business, well, the person self-funding it, yes.
Yes.
Okay, good. All right, so just a note here at the bottom, self-funding can provide an opportunity to cover a wider range of risks generally not covered by insurance policies. See, that's a consideration for self-funding. Okay, and in this particular topic, okay, or in the topics that follow from chapter 13 or study unit 13, all focus on self-funding. Right, so earlier we spoke about damages that were sustained during an earthquake. If I had a self-funded, let's say, account that we kept paying towards, that grew and grew and grew and grew, would you be able to self-fund damages from an earthquake?
Yes.
Yes. Would the insurance company pay for damages from an earthquake, even if you had insurance?
No.
Probably not, yes.
Nature.
Okay, because it's a natural disaster. Okay, it's
Natural
one of those risks that are going to affect a large majority of people. Right, and that's the introduction to self-funding.
Okay.
Okay, that was study unit 13. We need to now open study unit 14. Let's open up that set of notes. Okay. Alright, so support material, study unit 14 starts here. Okay, there's the introduction. Alright, so 3 questions to start with. What is self-funding, Melanie? How would you describe it? We just spoke about it not so long ago, so what is your definition of self-funding?
Okay, when the business keeps the risk.
Yes. Okay, the business is going to keep the risk. So retention, do you agree?
Yes.
Okay. Is there a limit to the amount of risk a company can self-insure?
No.
Is there a limit?
There shouldn't be a limit.
Okay, when we say a limit, so can you self-insure everything?
No, that's impossible.
Yeah, we can't. Okay, so what's the limit then for a company in terms of what they're comfortable self-insuring? What are we going to have to look at?
Restrictions.
Well, we're getting to that point, but if we're just looking at the limit, so okay, so let me ask you this. In terms of your excess, how did you determine your excess?
That's what the insurance company offered me, but they told me that if my premium decreases, my excess will increase.
Yes. Okay. So that's probably what they've told you. But also, do you agree the excess is based on what you can afford?
Yes.
Do you agree? So if you can afford damages in excess of, I don't know, let's say 5,000 in terms of excess, okay, you could then choose to self-fund a higher portion of the damages. Do you agree?
Yes.
Okay, so if it was 5, we could maybe increase that to 10, maybe increase that to 20, okay, or you might reduce it to 2 or reduce it to 1, okay, depending on what the limit is, okay, in terms of what you're comfortable with. Okay, because can we self-insure everything?
No.
No. So we need to look at certain things that are going to place a restriction on that. So what restrictions would we place on self-funding? If we're looking at a business, what would a business have to consider before self-funding a loss?
I think affordability.
Yes.
And what risks they are open to as well.
Correct. Income. All right. How much income does this company generate? What else? Would assets and liabilities affect your self-funding?
Yes.
Yes. Okay. Your assets and liabilities. Okay. Your financial position. Right. So if you're in a very bad financial position, is insurance a good idea?
Yes.
Yes, because now you need to protect those assets because those assets need to cover the liabilities. Okay, if those assets are destroyed in a disaster or in a fire, okay, and you don't have insurance, do you still have those assets?
No.
No, but you still have to pay the liability.
Yes.
Yes, and you see how risky that becomes.
Yes.
Okay, and that's why when you take out car, let's say when you buy a new car, what does the bank or what does the dealer want as security? They want you to take out insurance.
Yes.
Okay, because for the duration of that financing agreement, all right, the dealer or the financier, the bank, they're the one that's actually sitting with the asset, the car. And it's in their best interest for you to have, or for them rather, for you to have insurance on that vehicle.
Yes.
Okay. Right, so when looking at self-funding, the firm is going to look at its ability to cover potential loss. Right, does a firm have a budget?
Yes.
Yes. Must the budget provide for operational expenditure?
Yes.
Yes. Is risk part of operations?
No.
It would be because now you're self-funding it.
Yes.
Okay, so if we have a fire, who pays for it? The business.
The business.
So would the business have to budget for that?
They would have to if they self-funding.
Yes, they would have to allocate a portion of their budget towards items that are self-funded. Okay, so discussion point, Melanie. What risks are you comfortable self-funding?
I think type 1 and type 2 losses.
Okay, some
Excuse
examples.
me.
So what do you self-fund? What are risks that you're comfortable with?
I think theft.
Death.
Yeah.
Okay, so you don't have any life cover.
Oh, you mean personally?
Well, that's what you're discussing. Risks that you're
okay.
comfortable with self-funding.
No, I think life insurance is very important.
Yes, okay, you've got your little boy.
Yeah.
Okay, he needs to be looked after should something happen to mom and dad, right?
Yes.
Okay, so that's an important point. So are you comfortable self-funding your child's education?
No, education is very expensive.
Okay, no,
So
you've probably covered that in terms of risk.
Yes.
Okay, what else? What? So those are things that you are covering. What are things that you're not covering?
Well, I don't have insurance on my cell phone.
Okay, so do you agree that's a risk that you're comfortable with?
Yes.
Okay, why are you comfortable self-funding your cell phone?
It won't be that expensive to replace.
Yes, okay, because do you agree the budget would be able to provide for a new phone should something happen to your current one?
Yes.
Okay, what else?
I think in terms of your maybe windows getting damaged, that I'm comfortable replacing that.
Okay, so have you self-funded that? Okay, so so in terms of your home.
Yeah.
Okay, so have you self-funded that? So if there are damages at home, you need to pay for it yourself. There's no insurance cover for that.
Yeah, like the one day my son was playing cricket and he hit the ball on the window, it cracked, so we just replaced it ourselves.
Okay, so yeah, so that was something you self-funded, yes.
Yeah.
Okay, what else? Anything else? One more. Can you think of anything else that you're
okay, my
self-funding?
handbag.
Pardon?
My handbag, it's not insured, so if it
Yes.
gets stolen, I'll be able to replace that.
Okay, good. So yeah, personal items. So you spoke about a cell phone, you spoke about a handbag, but generally personal items generally aren't really insured. They're more often than not self-funded, obviously depending on its value.
Yeah.
Okay, so that's the important bit. It's the value and it's the budget. Okay, if you had I don't know what sort of brand of handbag you have, but I'm just going to give an example as an example. Okay, let's assume the handbag was like a Louis Vuitton handbag that cost 100,000. Would you insure that?
You would have to.
Yeah, you'd probably consider
Yeah.
insuring it, because now
Yeah.
that handbag almost costs as much as a car.
Yes.
Okay, so that's something to consider. All right, so obviously value is important and budget is important. Okay, so if you think about it practically, okay, will a company need to establish its ability to cover its loss?
Yes.
Yes. And how does a company do that? By looking at these different factors. All right. So as an individual, when we're looking at you as an individual, you're looking at things that you can pay for. So it's easy to pay for a broken window. It's easy to buy a new cell phone. Okay, those aren't very expensive items to replace or to repair. Do you agree?
Yes.
Right. The same thing happens with the company. The company is going to look at its working capital, its total assets, its earnings, and its earnings per share, and its sales. Why is the company going to look at this? It's to determine its ability to cover or to self-fund. Right, so the question here that chapter 14 rather, study unit 14, is trying to answer is, how much is the company able to afford in terms of self-funding? That's what study unit 14 is looking at.
Okay.
Okay, so are there any other factors that can restrict self-funding? There are. Things like risk profile, risk appetite, non-financial factors, external, so the market factors, maybe the economy, those types of things. Okay, so maybe just one example just to relate that to what we've been discussing here. Okay, what sort of view do you have on risk? Are you the type of person that's worried about everything, or are you more the type of person who doesn't really worry too much about problems that arise? What sort of profile do you have as a person?
I think I worry a lot.
You worry a lot.
about
Okay,
it.
so you're
Yeah.
more conservative then in terms of your risk profile.
Yeah.
You don't take
Yes.
too much risk.
Yes.
Okay, so if you don't take too much risk, you're probably the type of person who will have insurance on a lot of different things.
Yes.
Okay, so you've got insurance for all the assets that are important. Okay, so the house, the car, obviously medical aid, medical insurance, disability cover, those types of things.
Yes.
Okay, and why? It's because of your risk profile. All right, the same thing happens in the company. The company may be very aggressive or maybe more conservative. Okay, companies are either aggressive or conservative depending on their profile, but also depending on this, their working capital, their assets, their resources, and so on. Okay, so when answering this question, how much is the company going to self-fund, we need to consider this, liquidity, working capital. Right, that's factor number one. Okay, so the factors we saw on the previous page, I've expanded on them on the next few slides. Okay, so slide number one here is looking at the liquidity. If I'm looking at working capital, what is working capital, Melanie?
Working capital is the money that you can make when you sell your assets.
Okay, the difference between your current assets and liabilities. Do you agree? Okay, so if I'm looking at current assets and current liabilities, let's say CA minus CL gives us 2, okay, for company A. And then we've got company B, current assets minus current liabilities gives us 5. Which company would be able to afford more self-funding?
Company B.
Yes, okay, B would be able to self-fund more expenses than A, right, because of its working capital. Right, so can a company meet all obligations? Normally. Okay, how do we measure that? We measure that through its liquidity. Okay, so the current asset ratio or the asset test ratio. Those are ratios that would determine the company's ability to cover its obligations. Okay, short-term obligations. Right, so what is the guideline in terms of companies and how much they can afford? Okay, remember, we're trying to answer this question. How much can companies afford to self-fund? Right, so the guideline is this. 1 to 25% of working capital should be the limit to your self-funding. The ability to self-fund losses will depend on its working capital. Right, so if I have a company that has, let's say, working capital of R1,000,000, what should that company use as a guide in terms of its self-funding? 1 to 25%. Okay, what is 25% of R1,000,000?
250.
250,000. What's 1% of R1,000,000?
100,000.
10,000.
10,000.
Yes. Okay, so as a guide, a company should be looking between 10,000 and 250,000 Rand worth of loss that they should be willing to self-fund, because their liquidity would be able to provide for it.
Okay.
Okay. Right, so here's another question. Right, Melanie, if you were earning R1,000,000 a month, okay, would you take out car insurance?
No.
Why not?
I can self-fund it.
Exactly. Okay, because 1% of R1,000,000 would be 10,000. That would easily pay for a scratch.
Yes.
Okay. Or if you looked at the upper limit, 25%. So 25% of 1,000,000 as part of your working capital is 250,000. Is that enough to buy a new vehicle?
More than enough.
Yes. Okay. So every month you could buy a new vehicle if that was the case. Do you agree?
Yes. Yes.
Okay. And that's what a company needs to look at. The company needs to look at their liquidity, because the liquidity determines how much they can self-fund. Okay. So as an individual, if you were earning R1,000,000 a month, there's no need for car insurance.
No.
Okay. There's no need for a lot of insurance if you think about it.
Yeah.
Okay, because majority of those minor, inverted commas, minor expenses can be paid for with R1,000,000 a month. Okay, right, but certain assets that you might have may still need to be covered. Right, in the event. So if you are earning R1,000,000 a month, would you still consider life insurance?
Yes.
Yes. Okay, because that's something that would affect your loved ones. Okay, in terms of that. Okay, good. Right, are working capital requirements always constant though?
No, it can change.
Yes, it can. And that's why it becomes very problematic for a company to determine how much they're able to self-fund, because the current assets and current liabilities can change day to day, month to month. And that creates a problem. Okay, so that's why they use a guideline. 1 to 25% is the maximum amount that we should be self-funding in terms of loss. Things to also consider: seasonality, aggressive versus permanent. Okay, I've tried to relate this to your finance, your FIN 3702. There they also spoke about seasonality, and they also spoke about aggressive versus permanent. Same thing will apply here, because a company is going to be looking at what? Its working capital. And you know, FIN 3702 is all about working capital.
Yes.
Okay, short term everything. Right, so that's something that you would consider here when looking at the risk. Right, here's another factor. Okay, so factor number 2, remember the question is, how much self-funding can we afford? Another consideration is the total assets. Okay, a portion of your assets are available to absorb your losses. Okay, so Melanie, what do you think is a practical percentage of total assets that we should use as a business to cover self-funded losses? What would you be comfortable with as a business, as a company?
20%?
20%. Okay, so that means if you've got assets, okay, so total assets, okay, we would be happy to sell 20% of our assets to cover losses that we've self-funded. Okay? They've actually looked at 1 to 5%. That's the guideline in terms of risk management. Okay, 20% is quite high, because that's 20% of your assets. So your land and buildings.
Yeah.
Okay, can you sell 20% of your land and buildings?
No.
No, it's going to be difficult to do that. Okay, 20% of your total assets. Okay, so 20% of your total assets is a big amount. You might have to start selling land and buildings. Okay, if it's 5% or 1% to 5%, is that more manageable?
It is.
It is. Okay, so that's the guideline. Right, so companies are guided by a guideline of 1 to 5% of their total assets. So if a company is unsure as to how much they should be self-funding, they should be looking at their total assets. Okay, so if the land and buildings come out to, or let's say if all the assets come out to 100 million, okay, for that company, how much should they self-fund as a maximum? 1 to 5 million. Do you agree?
Yes.
Okay, and that would be their self-funding. Meaning, if something had to occur and they self-funded it, 1 to 5 million as a loss would be what we would be comfortable with covering. Okay, so if the let me talk about the company. Okay, so if the theft in the business amounts to 1 million, should we transfer it or self-fund it?
Self-funded.
Correct. Okay, because with our assets being 100, we would be able to easily cover 1 million rand worth of theft. Okay, so with assets, how are assets financed?
Through loans.
Or debt or
Debt.
equity?
Equity.
Yes. Okay, so with debt or equity, those businesses are going to be financing those assets either through loans or through equity. So is leverage going to be a factor?
Yes.
Why?
Can
highly leveraged companies self-fund large losses?
Yes.
No, they can't. Okay, think about it. If a company is highly leveraged, what does that mean?
Oh, it means that they have more debt.
Correct. It means they've got lots of loans. So if that company has a lot of loans, is it a good idea to self-fund large losses?
No.
No. Okay, so a company that's very aggressive is going to have more liabilities than assets. And that's why those companies aren't going to be able to self-fund those large losses. Make sense?
Yes.
Okay. Next bit, earnings method and EPS. Okay, these are the two. Right, so again, we've got a guideline here. Right, so in terms of earnings, what should a company be comfortable with in terms of self-funding losses? Well, 1 to 3% of retained earnings plus 1 to 3% of the pre-tax earnings over the last 5 years. That should be the guideline that you should be using when establishing how much a company should be self-funding.
Okay.
Okay, with earnings per share, EPS is used as a conservative measure to avoid being overextended. Right, proportion is subject to the company's management's discretion. Okay, so there is no specific guideline here that they've provided for in terms of theory. Okay, theory says management needs to decide on a applicable, let's say, a proportion of EPS. Okay, earnings, remember, are measurable. Earnings per share, those are, let's say, calculations that you do based on a ratio, which could be adjusted for certain changes. Alright, so generally, a company is going to be looking at its earnings, because the earnings can't really change. The earnings are the earnings. Right, 1 to 3% is what the company would be comfortable with self-funding. Right, because then those losses are manageable. They're not going to put the business out of business.
Okay.
Right, now we need to look at the sales budget. Okay, is sales the most important line item on the income statement? Statement of financial position, statement of comprehensive income.
It is.
It is.
The first
Why?
line. It's the first line on the.
Yeah, it's the first line, and what does it cover? It covers all the
Income.
expenses.
Yeah, it's income.
Okay, sales covers all the expenses, the revenue.
Mm-hmm.
Do you agree? Okay, the first line item is the line item that covers all the expenses, right?
Yes.
Okay, so which is the most important line item to analyze? The sales. And that's why companies place a huge emphasis on selling, okay, on sales, because the sales actually allow the business to operate.
Great.
Okay, so an indication, okay, or indicator measuring the firm's ability to generate revenue. If firms are capable of generating more revenue, can they afford to self-fund more risks?
Yes.
Yes, they can. Right, so if a company can operate and generate more revenue, they would be able to self-fund more losses. Right, the guideline here is 0.5 to 2%. Okay, the reason why I've put all of these percentages in blue is because I have seen questions before where they've literally asked you, okay, about the actual self-funding. Okay, how much do we need to afford? Okay, or how much can we afford? Right, so you do need to know those ratios. Okay, 0.5% to 2%. Okay, it's a little bit of let's say theory that is applicable in a longer question. Okay, and remember, longer questions is generally what they test this particular section. Okay, in terms of the questioning in the exam. Okay. Right, just something to consider. Will different entities have different levels of sales?
Yes.
Okay, so selling burgers versus selling houses. What would the level be?
I think there'll be more burger sales than houses.
Exactly.
But in terms of value, houses are much more expensive.
Good. Okay, so that's also quantity versus price. Okay, so we're going to be selling a lot more burgers than we will houses. All right, so the level of sales will also affect the business because, do you agree, selling burgers will have more cost than selling houses?
Yes.
Okay, so operational costs are going to be higher or greater for a burger business than an estate agent, let's say. Okay, the expenses for an estate agent would be limited. Okay, there wouldn't be as many expenses because an estate agency would be mainly a service, while a service offering a product rather than actually selling burgers.
Yes.
Right, so all of the above are measures to assist in determining the constraints of the entity in self-funding risks. Right, they did give you a few examples in study unit 14, which I've just tried to refer you to there, okay, in terms of some measures. It's on page 113 in your study guide. Okay, just a concept that we need to always remember is risk aversion. Okay, this is actually coming from finance. We spoke about risk-adverse investors or risk-adverse financial managers. If I'm risk-adverse, do I want to take on more risk?
Yes.
Yes, only if the risk outweighs the return. Okay, so risk aversion, interpretations and views based on the attitudes, the management style, and even the corporate culture. Right, so do you agree some companies are just by nature very conservative? Other companies are very aggressive. Okay, so startup companies are more risk takers, okay, in terms of taking more risk. More established businesses are more conservative. Right, so where would you fit your business in? Okay, so your company, in terms of risk, okay, where would you say your business fits in terms of its attitude or its style, its management style towards risk? How would you say? What would you say your company's view is on risk? The more conservative side or the more aggressive side?
I think they're conservative.
More conservative. Okay, so do they put in a lot of risk management procedures and policies and things like that?
Yes, they do.
And are you paying premiums for certain things as well?
Yes.
For covering risk?
Yes.
Okay, so yeah, so if you've got lots and lots and lots of policies for different items or different things in terms of cover, then you would definitely say the company is more conservative than aggressive. Okay. All right, so looking at risk retention then. Okay, that was chapter 14. Chapter 15 is looking at the risk retention. What are we focusing on here if we're focusing on retention, Melanie?
We want to retain the risk.
Correct. You're keeping it. Okay, keeping it within the business. Right, so can companies keep risk?
Yes.
Yes. Do they do that intentionally or unintentionally?
I think intentionally.
Yes, and sometimes it is unintentional as well.
Yeah.
Okay, because sometimes risk isn't identified. Okay, so you might not have thought of a particular risk and then that risk arises. Okay, for example, who would have ever have thought that earthquakes would be a reality in this country?
Yes.
Okay, so do you agree we've unintentionally self-funded that risk?
Yes.
Okay, if we know that earthquakes are a reality and we still choose to intentionally self-fund it, well then we've retained the risk. Okay, so retention is just keeping risk within the business, where the business needs to cover its own losses. Do you agree?
Yes.
Okay, so then you've got two different types of retention. You've got funded and you've got unfunded retention. Funded is where there's a special risk fund. Okay, so notice we're not looking at transfer. Remember that diagram? We're transferring risk or retaining risk. Here, have we got risk in the business?
Yes.
Yes. Okay, so if we are going to be self-funding these risks, we're going to have a separate fund for it, and that's going to be a funded retention, okay, risk fund, because now we've created a provision for it. Right, so have we self-funded the risk? Yes, because we've identified that particular risk as being a concern, and now we've put aside a certain amount of finance or funds to provide for that risk. Okay, if it's unfunded, those losses are going to be covered with cash flow. Okay, so here's my question to you in terms of funded or unfunded. Okay, you mentioned you're not taking out insurance for your cell phone. Okay, are you funding it yourself though? So are you automatically putting away a certain amount towards a, inverted commas, cell phone special risk fund?
No.
You're not?
No.
Okay, so would you agree you're viewing it as an unfunded retention, meaning the phone will be covered with your cash flow?
Yes.
Okay, good. Right, that's the difference between the two. Right, so the one is you're creating a specific fund for it, and the other is you're just going to fund it with the cash flow that you have as a business. Make sense?
Yes.
Okay. A variation of self-funding is a deductible. Right, so a deductible is actually very similar to an excess. Okay, I want to try to relate it to something that you're familiar with. Excess. Okay, using deductibles is self-funding. That's what we're dealing with. Okay, a deductible is the self-funding portion of the risk event that you have. Okay, here's the notes. Right, we're looking at the 6 pages in your study guide. That's where you find the information. Just to summarize the information, what is a deductible? It's part of the insured loss the company retains. Okay, it's self-funded. Okay, it's what you are going to say, I'm happy with taking on as a loss. Okay, because remember we're looking at companies insuring certain losses. When they arise, there'll be a payout. What are they going to be comfortable paying out? Well, the self-funded portion. Okay, so insured has cash flow benefits and cash flow protection when deductibles are used. Right, why? Why are there benefits here, Melanie? What did we say earlier? Who gets the premium?
The company, the business.
The business keeps the premium. Yeah, there's no
Yes.
payment of a premium to an insurer.
Mm-hmm.
Okay, so what premium will the insurer charge if a deductible is included? Higher or lower?
A lower.
Lower premium, yes, a discount, good. Okay, so how is cash flow protection achieved then, Melanie? Because as the insured, we need to protect our cash flow. Right? What did we say is going to happen? If we elect to choose a deductible, okay, are we going to pay a higher premium?
A lower premium.
A lower premium, yes. Right, so when paying a lower premium, the self-funding is present, but larger losses are capped, and the insurer assists with the damages. Okay, right, so when I'm looking at cash flow protection, how is it achieved? Well, do you agree, what does the deductible do? It helps cash flow.
Yeah.
Okay, it helps cash flow because I'm going to be paying a lower premium. Because you're comfortable self-funding a certain amount of the loss.
Mm-hmm.
If the loss is excessive, who pays for the loss? The insurer.
The insurer.
Yes, because they pay the amount exceeding that deductible. Alright, so here's an example, just to highlight what I mean by a deductible. Okay, the first deductible we're going to be looking at is straight line deductible, okay, or straight deductible. Not straight line, straight deductible. Okay, a straight deductible applies to every loss, subtracted before a claim is considered or paid. Okay, so the example, we have a 10,000 Rand loss in the business. If a deductible is in place, how much does the insurer pay if the deductible is 12,000? Does the insurer pay? Melanie, what do you think?
The insurer will pay 4,000 Rand.
The insurer wouldn't pay anything if the deductible is 12,000. Who pays for the loss? The business.
The business.
Okay, so do you agree you have the business? Okay, the business is going to take out insurance, right?
Mm-hmm.
Okay, the business has taken out insurance with the deductible of 12,000, meaning only losses in excess of 12,000 will be covered by the insurer.
Okay.
Does that make sense?
Yes.
Okay, so nothing will be paid up by the insurer. Who pays for the loss of the business? The insured. Okay, what happens if the deductible is 6,000?
The business will have to pay that.
How much? The
Sorry?
business pays how much?
The 6,000.
Yes, and the insurer pays how much?
Nothing.
4,000.
4,000.
Okay, so it's very similar to an excess. Okay, but remember, this relates to a company. So a company will have a deductible. Right, remember, as an individual, we talk about an excess on your vehicle.
Okay.
Do you agree? We don't talk about a deductible on your vehicle.
Okay.
Okay, but a deductible is similar to an excess. It's just something that you're going to end up paying.
Okay.
Okay. Aggregate deductibles are going to be looking at losses over a period of 12 months. Right, and that'll be predetermined. Okay, so if I have an aggregate deductible, right, the business could have something like 120,000 Rand. Okay, aggregate deductible. Meaning, is the business comfortable self-funding 120,000 Rand over a year in terms of loss?
Yes.
Yes. Okay, what happens if the business has a claim at the beginning of the year. Let's say there's damages of 50. Okay, then there's damages of 60. And then there's damages of 10. Okay, in the first 3 months of the business. Okay, would the business have used up its deductible?
Yes.
Yes, they would have. If I add all of this up, I'm going to get 120,000. Right. Have we used up our deductible?
Yes.
Yes. Okay, now what happens if the business continues to make losses in the next month? So in month 4, there's now another 10,000 Rand loss. Who's going to fund that?
The insurer.
The insurer, yes. Okay, so an aggregate deductible is literally a way that the company can establish what is the current level of self-funding that I'm comfortable with. When things reach that point, then I need the insurer to step in and to cover those losses.
Okay.
Make sense?
Yes.
Great. Right, and then you also get a disappearing deductible, which is going to be using a formula. Right, the formula is P equals L minus D times 1 plus R. Okay, where P is the payment. Okay, notice it's the issuer's payment. L is the loss, D is the deductible, R is the recapture factor. Okay, the recapture factor needs to be given in the question in order for you to calculate one of the missing figures. Right, so I've given you an example here just to show how you would calculate this. Right, so a policy has a 10,000 Rand deductible. Okay, so what does that mean? For someone who didn't know what a deductible is, what does that mean, Melanie? Has the company self-funded a specific amount of loss?
Yes, the 10,000.
The 10,000, exactly. Good. Okay, and there's a recapture factor here of 5%.
5%.
What would the insurer pay for a loss of 90,000? Okay, so what is the loss actually? 90,000. Do you agree?
Yes.
Okay, this is a disappearing deductible, meaning the deductible will be affected. Okay, so what does the insurer pay? Well, 9,000 minus 10,000. Okay, because the deductible was 10. Okay, so anything in excess of 10 will be paid by the insurer. Do you agree?
Yes.
Okay, then we need to look at the recapture factor. So if I multiply that by 1,05, which is 5%, the deductible has been reduced from 10,000 to 6,000. Okay, why? Because we're looking at the difference, okay, between what you've claimed, okay, and what the actual claim was in material, in measure, okay, in amount. Right, so what was the actual amount in terms of the loss? 90,000. Okay, is the insurer going to still want to pay 10,000? The insured. Is the insured still going to want to pay out 10,000?
No.
No, and that's why they reduce the deductible. Meaning, with more losses comes a reduced deductible. Only if I've got a disappearing deductible. Because do you agree, at some point in time, the deductible will disappear. And if the deductible disappears, what does that mean? Do you have more cover or less cover?
More cover.
You've got more cover because now you're funding most of it externally. Okay, you've transferred more of your risk to the insurer.
Yeah.
Okay, so a disappearing deductible means I've got a certain amount that I'm comfortable with in terms of covering loss. Once I've used up all of it, now I want the insurer to pay me for all the loss that I incur. Make sense?
Yes.
Great. Okay, then we've got a franchise deductible, very similar to a franchise we saw earlier on in the semester. Okay, what is a franchise deductible? It's a stated amount used as a basis. Any amount exceeding a stated amount will be covered 100% by the insurer. Right, notice full payout for the insured. Okay, so here's the example. If you've got a franchise deductible of 100,000 as a business, Okay, if there's a loss of 120,000, who pays how much?
The 100,000.
Well, let's talk about the loss. We said 120,000.
Mm-hmm.
If there's 120,000 rand loss, who pays for it? Is that self-funded or does the insurer pay it?
The 120,000 and loss, the insurer will pay it.
Very good. Because the full amount is covered by the insurer because it exceeds the deductible.
The 100, yeah.
That's correct. Okay. Right, then you have determined the deductible levels. This is just a least cost rule. Okay, meaning, what are we going to be considering? We're going to be considering the, how can I put it? The option that reduces the risk the most. Okay, so the least cost rule. Cost of risk to a company equals the insurance premium plus cost of loss retained. Okay, the deductible. Okay, that's your total expected cost. Okay, why do I have the total expected cost? Because the total expected cost is what I believe will occur if a loss had to arise. Okay, so there's two things that you need to consider here. The insurance premium and the frequency of loss times the deductible. Okay, what did we say the deductible is going to be giving us? The amount that the insured is willing to cover themselves. Do you agree?
Yes.
Okay, so Q is the average frequency of loss occurrences. Okay, did I give that example here? No, I didn't. Okay, we need to go to the textbook to show that example. Not textbook, study guide. Okay, let me open up the study guide. Okay, I need to show you this example. There's an example here in the study guide covering this is 15. Where is it? I don't think I've opened the right one. No, this isn't the right one. It's the other file. It's this one. No, that's not the one. Where's the other file? Oh, there we go. That's the one. Okay, here's the one. The 197 page one document. Okay, this is the one. Alright, let's go to the... Where's the self-funding bits? Okay, there's it. We're looking at risk retention, okay, which is study unit 15. 15, 14. There, deductibles. Okay. This is page... That was chapter 17. No, back, 16. There, this should be 15. Yes, this is 15. Alright, there's it there. Okay. Alright, so here's the example I wanted to show you. Okay, so remember earlier we spoke about are we going to retain or are we going to transfer the loss?
Mm-hmm.
Okay, so now have a look at this example. It's actually a really good example to consider what you should do. So, Melanie, remember I asked you about, are you paying a high premium and a low excess?
Yes.
Okay, and then you said you're paying a low excess and a higher premium.
Yes.
Right. Do you agree what we should actually do is we should weigh up the premium and the deductible? Okay, so remember the Q. The Q stood for oh, sorry, that's my notes, not this file, my notes. Sorry, I had it on the notes. Here's the notes. Okay, Q stood for the average frequency of loss occurrences. Do you agree?
Yes.
Okay, so let me ask you this. Melanie, what frequency of loss would you attach to being in a car accident? How often are you in a car accident?
Very low frequency.
Very low frequency of loss. So as a percentage, 100% meaning it's going to happen. Melanie will be in a car accident. That's what 100% is. So obviously, it needs to be an average frequency. So what would you say is the on average percentage that you would have for being in a car accident? 20% chance of being in a car accident? 50% chance of being in a car accident?
I'll say 5%.
5%. Okay, that's very low, hey?
Yeah.
Okay, so if we're doing a total expected cost calculation, we're going to have to take your premium and we're going to have to add it to 0.5% of your excess. Okay, the deductible. The deductible is your what? Your self-funded portion. Do you agree?
Yes.
Okay,
yes.
So when I go back to this page, okay, what they're discussing here in this scenario, okay, is looking at a very similar scenario as what we had earlier where we spoke about a car accident. See, here's it. Okay, number of vehicles, number of incidents, and the total cost. Okay, so when looking at this, obviously based on data, they will give you the data, okay, and they won't even give it to you as complicated as this because this is taking a bit too far. Right, but if I look at this, how many vehicles do I have? 10,000.
2,000.
How many
10,000.
incidents do I have a year or over the years? How many incidents have I had?
2,000.
2,000. So the probability of having an accident for this company is 2,000 over 10,000, which is 0.2. What is 0.2?
Yeah.
It's the
2%.
Q. It's the expectation. It's the frequency of loss.
Loss.
Okay. Does that make sense?
Yes.
Alright, so Q is how frequent that particular event occurs. Right, so if I'm looking at the year from 1998 to 2002, okay, of the 10,000 vehicles that we've got over those years, we've had a total amount of incidents or accidents of 2,000. Does that make sense?
Yes.
Okay, and that's the amount that I've spent over that period of time. Right, so if I'm looking at the number of incidents, okay, that I have per year, or not per year, but in general, per event, okay, for the event of being in an accident, it's 0.2. Right, so 0.2 is the probability of being in an accident. So here's the discussion. Right, the business is offered these premiums from who? The insurer. Okay, the business knows that on average 20% of the cars are in an accident, and if that's the case, you're going to times it by the deductible, which is what you're self-funding. Does that make sense?
Yes.
Deductible. Okay, so if I look at option 1 is to go with a high premium and no excess. Okay, so if I have no excess, I end up paying nothing for all those events if they do occur. But do I always pay the premium? Do I always pay the premium?
Yes.
Yes, the premium is always paid. That's a certainty. Right, so that's your total expected cost. Is that high or low? That's high.
Yes.
Right, option 2 is let's reduce the premium, but now if I reduce the premium, there's going to be a deductible, i.e. an excess. Okay, so that's the premium. This is the probability of being in an accident, and that's how much I'm going to have to pay if I'm in an accident. Does that make sense?
Yes.
Okay, so the total expected cost is 3,100. Is that better than the first option?
Yes.
Yes. Okay, then we do that with the third option. That's the premium now. Notice the deductible goes up. Percentage times the deductible gives us 500. Better or worse than before?
Better.
Better. Now we look at option 4. Let's reduce the premium by more. And then we have that option. Okay, then we have that cost. Higher or lower?
Slightly higher.
Slightly higher. Correct. Okay, then if we keep going, notice, if you have a very low premium and you have a very high excess, does that benefit the business? No, because the total expected cost will be 20,650. Okay, so which is the best option here, Melanie?
Option 3.
Yes, this is the best option. Okay, the business is going to choose a premium of 2,405 a month with a deductible of 2,500 based on the likelihood of being in an accident. Okay, so the point I'm trying to make with this discussion is when looking at your premium and excess, okay, you actually need to try find the middle ground where you're not paying a very, very high premium, you're not paying a very, very low premium, and your excess isn't very high or very low. It's just in the middle. That's the ideal place that you want to be. Okay, so is asking your insurer for the lowest premium the best option?
No.
No. Is it the best option to ask them for the lowest premium but the highest excess?
No.
No, it needs to be somewhere in the middle. You need to have an excess, okay, and there needs to be a premium. But it all depends on your likelihood of being in an accident.
Yeah.
Okay, if the probability of being in an accident is greater, then this table is going to be very different. Do you agree?
Yes.
Okay, because let's think about it. If I had to change these figures, let's say the probability went up to 50%. Okay, 0.5 times those amounts is going to give us a very different table. Okay, and then we might go with maybe higher premiums and lower excess if the likelihood of being in an accident is very high. Okay, so that's the concept this table is trying to explain to us. Right, so let me ask you this question. Okay, Melanie, you know that your likelihood of being in an accident is only 5%. That means you're a very careful driver.
Yes.
So my question to you then is, why are you still paying such a high premium then, if you know that you're so careful?
I don't know, the uncertainty of things happening.
Okay, it's because you're maybe more conservative. So even though there's only a 5% chance of Melanie being in an accident, okay, Melanie would rather still have peace of mind by paying the highest premium and having the lowest excess.
Yes.
Because it makes you sleep better at night, because that's your risk profile. That's your appetite for risk.
True.
Okay, so paying a higher premium is fine with you because that's your preference. You would rather have more cover than a higher excess because you'd rather not have to self-fund it yourself.
True.
Okay, and that's what this table is trying to communicate. Does that make sense?
Yes.
Awesome. Okay, let's close that, and that wraps up that section. Yeah. Okay. Alright, we've just got some theory to cover. Do you need a quick break, or do you want to push on?
No, we can carry on.
You sure? Alright, so let me close that one. We've got, I think it's about 17 slides. Yeah, there's 17 slides here in the last bit. Okay? And it's all theory. There's no calculations in this particular set of slides. Okay? Alright, so there, last two chapters, study unit 6, study unit 17. Remember, they all come from the study guide. The study guide gives you a few pages covering each section. Right, the pages aren't very long. It's not as hectic as your textbook, the one that you had to get from the Institute, okay, of Insurance. Okay, so the Insurance Institute. Right, so study unit 16 is focusing on a captive and a rent a captive. Okay. We need to know what a captive is. Alright, so I want to ask you generally what you think a captive is before I tell you what it is. What do you think a captive is? Okay, or generally, when you hear the word captive, Melanie, what does that mean?
Someone that has been captured.
Correct. Okay, someone that has been captured. Right, we're not going to be looking at people that have been captured, okay, as a captive. But a captive is looking at the self-funded, okay, let's say pool of funds, okay, the resources. That's what we're looking at. Okay, so remember those resources we spoke about that you're going to keep for your own benefit? Okay, we could use a captive to keep all of those benefits in a particular, inverted commas, company. And that's what a captive is. Right, so let's start off with an introduction. There are numerous captives around the world. Places like Bermuda, Isle of Man, Luxembourg, United States. Okay. Oh, USA states, not the whole of the US, just different states. Singapore have domiciled captives in existence. Okay, so knowing which countries where you have all these captives, okay, what do you think a captive is going to do? Why would you have a captive only in certain places in the world? What benefit do I have for starting a captive in the Isle of Man, or a company in the Isle of Man?
No idea.
Okay, tax benefits.
Oh, yes.
Okay, certain certain countries are tax havens. Okay, and other countries have other benefits. It might be easy to start a business or easy to create a company. Okay, so the most common, let's say obvious reason here would be tax incentives. Okay, so do you agree, if we're keeping all those premiums, do we want to generate a return on those premiums?
Yes.
Yes, so are you going to want to be taxed on those premiums that you're saving, that you're self-funding?
Yes.
No, you don't want to be taxed on those premiums.
No, sorry.
Because you want to earn the most return on investment as you possibly can.
Yes.
Okay, so would you consider saving that money in a tax haven or in a country that's taxable?
Tax haven.
In a tax haven, exactly. Right, so what is a captive? Oh, I didn't put the definition there. Okay, a captive, okay, what is a captive? It's actually on the next slide. Okay, a captive is an entity, okay, that keeps or manages, keeps all of the funds. Okay, when I say funds, I'm talking about the self-funded funds. Okay, remember you're self-funding certain risks. Okay, so a captive is an entity that keeps all of those funds. Alright, so remember risk financing. There's two types of risk financing, retention or transfer. Do you agree?
Yes.
Which are we looking at here, the retention or the transfer?
Retention.
We look at the retention, but the retention here is going to be transferred to a captive. Okay, so can you have DIY insurance?
Yes.
Yes, you can. Right, so DIY insurance is when the company is going to have their own department that processes their own claims. Okay, so I don't know if your company has a captive, does it?
No.
You don't have an internal business unit that processes claims for certain risk events.
No.
No, okay, so there's no captives. Right, and the reason for that is it possible to formalize self-insurance? Yes, but it's very expensive to do so. Okay, so formalizing self-insurance means what? Creating a captive. Okay, we'll look at what a remptor captive is later. But a captive is just an entity that's going to be paying out claims. It's almost like your business creating your own insurer. Okay, that's the best way I can put it. And here's the definition. Captives are defined as insurance or reinsurance companies, inverted commas, owned and controlled by a non-insurance related company. Okay, so are you familiar with lots of claims that are always take place in your company?
Yes.
Okay, what are the common claims?
Sometimes there's small fires in the factory.
Okay, fires. Okay, great. Okay, so do you agree? You guys are paying a premium to an insurer to cover loss for those small fires that occur in the factory.
Yes.
Okay. A captive would be your company creates a separate inverted commas company called a captive that is owned by your business. Okay, so your business would pay, inverted commas, a premium over to the captive. Okay, if there's a fire in the factory, who do you go to? Do you go to the insurer? No, you go to your captive. And what do? You submit a claim to the captive. Do you think the claim is going to be paid out?
Yes, it should be.
Of course it is, because it's one and the same business. Do you agree?
Yes.
Okay, so see, it's a way to formalize self-insurance, to have insurance for the insurer. Insurance for the insured. Okay, without the insurer.
Yes.
Okay, does that make sense?
Yes, it does.
Okay, great. All right, so that's what a captive is. That's the theory. All right, so captives act as normal commercial insurers. So what do normal commercial insurers do, Melanie?
They collect premiums every month.
And do they do a risk assessment?
Yes.
Yes, that's underwriting. Do you agree?
Yes.
Okay, and they also have to take that and they need to invest it, right?
Yes.
Okay, so invest, insure, reinsure. Those are all the things that they do. Okay, so what are captives going to have to do? The same thing. Right, are captives limited in terms of scope? What do you think?
If it's in-house, I don't think so.
Definitely not. Very good. Okay, but the parent company is going to determine what's paid out. Okay, why? Decision maker. Okay, so maybe I should have been more specific here. Okay, so if you said no because it's internal. Okay, the yes here in terms of limited, it's because the parent company decides what is and isn't paid out. Okay, so remember, you guys are part of a bigger parent company. Do you agree?
Yes.
Okay, let's assume your parent company had a captive. Okay, so if a fire broke out in the factory in South Africa, okay, you guys are creating the radiators. Right, who are you going to claim from? The captive. But the parent company, so sitting in Germany, the German parent company is going to decide whether or not the captive is going to pay out your damages in the fire or not.
Yes, they need to investigate and see how the fire started.
Exactly, yes, before they pay out. So
whatever.
The scope isn't limited. So if the fire was created because of negligence, okay, would the insurer pay out? A normal insurer?
No.
If it's negligence, no, they won't, because then it's your fault.
Yes.
Okay, but if it's a captive, would they pay out?
They would. Maybe they will claim from the employee.
From the captor?
Depending.
The captive.
Yeah.
Okay, well, maybe they could take some legal consequences in terms of who was responsible for the fire, obviously.
Yes.
Definitely.
Yes.
But if we were just talking about the captive, would the captive be limited in terms of scope? If it's internal, no.
No.
But it would be in terms of what the parent company says. Okay, so if your parent company in Germany says no, they're not going to pay for the fire in the South African factory, well then, you're going to have to foot the bill from your own cash flow.
Yes.
Yeah, you'll have to repair it yourselves then. if the captive isn't going to pay out because the parent company said no. Got that?
Yes.
Alright. So when you have an arrangement of captives, you've got direct and you've got indirect. Direct means there's going to be a premium, okay, where the captive and the parent company, okay, will have a direct relationship. Indirect is when there's fronting. Fronting means the parent and the insurer, okay, are actually who we're going to be looking at, but the captive acts as a middleman. Okay, it's seen as fronting because the captive is the one that actually takes out insurance with the insurer. Okay, because what is the captive going to do? Okay, is the captive acting in the best interest of the organization?
Yes.
Yes. Okay, so do you agree you've got the insurer, which is your captive, as part of the organization, batting on the same team?
Yes.
Okay, because the captive wants the best interest for the business. Do you agree?
Yes.
Okay, let me ask you this. If the parent company is going to get insurance directly from the insurer, are they separate entities?
Yes, they are.
Yes. Okay, so the parent company might not get the best, let's say, payout or claims from the insurer if they went direct. Okay, but what does the parent company do? The parent company gives all of its premiums to the captive. The captive then decides how best to spend those premiums in terms of, do they insure, do they reinsure, do they invest? The captive decides what to do. Right, so the captive may take out insurance with an insurer to pay out certain claims. Right, if it's in the benefit of the best interest of the parent company.
Okay.
Okay, so that's another reason why you would want to take out a captive. It's because everyone is seen as being on the same team. Okay, because now you're not going to be disputing you're not going to be disputing claims. Why? Because you're all part of the same organization.
Okay.
Okay, so are claims going to be paid out sooner and quicker?
Yes.
Probably, because it's internal. Okay, rather than having to follow an external process to get a claim paid out.
Okay.
Makes sense?
Yes.
Okay. Why are captives used? Well, the motivations. The first, greater efficiency or responsibility to the insured if the captive is a related party. Okay, which is better, Melanie? Being the insurer or being the insured?
Being the insured.
Being the?
Insured.
Insured, why?
Because you don't have to pay out the claims.
Because you don't have to pay out the claim, the insured.
Yeah.
Okay, the insured doesn't have to pay out the claim, so there's no loss, so the insured just gets the benefit. Do you agree?
Yes.
Okay,
yes.
fine. Okay, but what's the benefit of the insurer?
They
Keeping
maybe
all the
make
premiums.
profit. Yeah.
Do you agree? Okay, so
Yes.
what does a captive do?
The same as the insurer.
The captive is almost like the best of both worlds. Okay, because the
Yeah.
captive keeps the premium, which is the benefit that the insurer enjoys. Okay, but the captive is also insured because they're part of the company that's paying out the benefit.
Yes.
Do you agree? So it's almost like transacting with yourself in a sense.
True.
Okay, because the captive is a formal self. It's a formalization of the self-insurance. That's what you're doing.
Yes.
Okay. Right, so why are captives used? These are some of the motivations. Okay, the textbook, or not the textbook, the study guide went into quite some detail when they talked about captives. So I've actually given you a summary here in terms of bullet points. Okay, so number one, minimize or eliminate frustration. That's probably the biggest benefit. Okay, are you claiming from an external party?
No.
No. Okay, you're dealing with your own organization, just a different branch. Okay, and if it's internal, is it easier to communicate?
Yes.
Yes, and it's also easier to get payout.
Yes.
Okay. Captives may also allow special risks to be pooled. Okay. Can I cover risks that aren't insurable if I've got a captive?
I think you'll be able to cover everything.
Yes, you can. Exactly. Good. So notice, before you might have been too risky, but now you can create your own insurance, inverted commas.
Yes.
Okay, and a captive allows you to do that. Right, cash flow for the parent is important because that's investment income. Okay, so do you agree you're paying the premiums to who? The captive. Is the captive part of the company?
Yes.
Yes. Right, there's less disputes because it's internal. And the costs are reduced. Right, is there going to be marketing and sales here?
No.
No. Okay, you're not going to get someone coming and marketing and advertising their products or services because it's all internal. So does that save the company costs?
Yes.
Yes. Okay, because think about this. If the company had to take out insurance, the insurer is going to charge a premium that's going to cover all their marketing and sales costs.
Yes.
But now, if the captive does that for the business, there is no marketing and sales. Is there more that's going to be kept in the business?
Yes.
Yes, so self-funding is going to be better if there's a captive, because now everything goes into generating a return to cover any loss.
Okay.
Okay. Right, so we've looked at why captives use. Here are two other examples. Captives are free, inverted commas, because there's unlimited choice. There's less supervisory systems. Okay, would you have to be underwritten?
I'm sure you would have to.
Well, there wouldn't have to be underwriting because the captive is for the company, right?
Yes.
Okay, so the company would know if there are risks or not.
Okay.
Okay, so the debate that I've got here is, are conventional insurers better than captives? What do you think? Who has the better skill or ability, Melanie?
The conventional insurers.
Why? Why do you say conventional insurers?
Because they would have a broader knowledge of risks and stuff like that.
Would they have broader knowledge of the risks?
But then the other thing is, if you're a captive, you would know what risks occur in your organization.
Okay, it's
That's
internal. Yeah, it's more specialized. Do you agree?
Yeah.
Okay,
yeah.
so do you agree conventional insurers are more general?
Yeah, they're more general.
Okay, they offer you general policies, general cover, general everything.
Yes.
Okay, a captive can offer you more specialized services. Not to say conventional insurers don't also offer specialized services, but that's just something else to consider.
Yeah.
Okay, so in terms of better skill and ability, it's called a mastermind concept because a mastermind concept is where you have lots of different individuals all contributing toward that mind, okay, that middle ground. Okay, so having expertise from many people creates a much better business. Okay, because you're sharing the knowledge, you're sharing the information. Okay, will a captive share the knowledge and information with the parent company?
Yes.
Of course they would. Right, so where would a captive be domiciled? Where would they want to be created? In a country where there are benefits or in a country where there aren't?
Where there are benefits.
Where there are benefits. Right, so supportive environments, where there aren't too many controls, where there are less restrictions, where there are tax incentives perhaps. Okay, and that's why you saw all those countries earlier. Okay, obviously the one that should have stuck out was Isle of Man because of the tax benefit, tax haven. Isle of Man is a tax haven. Okay, there aren't taxes, or there are, let's say, more favorable tax laws in that country than in other countries. Okay, make sense?
Yes.
Okay, right, we're almost there, last few slides. Okay, what is the risk of having a captive?
Maybe excessive claims.
Okay, possibly, yes. So the excessive losses that could actually affect the company. And what else?
Maybe misuse of funds.
Okay, could be. All right, so administration, do you agree?
Yeah.
Right, so now think about this. Before, self-funding was self-funding. Now you're creating the separate entity. Is there going to be compliance in terms of the Act, in terms of Companies Act and so on?
Yes.
Yes. Okay, so more legislation. Okay, more admin, more rules, more processes. All right, so management could be more inefficient because now you're spreading yourself too thin. Because before, you were only going to be providing a product and a service. Now you're providing a product and a service, and you're creating your own insurance company as well as part of the business. Okay, which can create inefficiencies. Right, so there are feasibility studies that can be done to determine when a captive would be most appropriate. Okay, we'll be looking at things like risk control, we'd be looking at statistics, we'd be looking at nature and limit of risks, we'd be looking at cost versus benefit, premiums versus claims. Those are all some of the different things that you would have to consider before a company is going to have to create a captive. Okay, and also we need to consider management. Who's going to manage this captive? Okay, internal versus external management. Okay, because yes, you've got internal people managing the captive, but now what happens if you're asking the captive to pay for negligence within the company? Is that a good idea?
No.
No. Okay, see, there's a lot more responsibility here. Okay, because now the captive needs to pay out for certain losses within the business. But now, how do you determine which losses you pay out and which you don't pay out? Because even the captive will have limited resources. Do you agree?
Yes.
Okay, and that's a consideration. Right, so what's the next best thing? Well, to avoid all those management inefficiencies and all the administration, if a company is wanting to formalize its self-funding, they can rent a captive. Okay, so rent a captive means you're using a different company or organization's captive. Okay, so big companies will have captives. Right, because, I mean, think about a big company. I don't know, are you aware of how much premiums you guys pay your insurers every month?
No, I'm actually just thinking about that.
Okay, it might be in the millions.
Yes.
Okay, you might be paying a 1 million rand premium every month. Do you guys get that 1 million rand back?
No.
No. Yes, it's peace of mind because if you have to claim, then you get something back. But think about it. If your company had a captive, you'd be saving or investing 1 million rand a month.
Yes.
And what about if we talk about a big company in the billions of rands?
Sure.
Okay, or like big multinationals. Let's think about big companies. Your Apple.
Yeah.
Okay, and your Samsung. Okay, and your Google. Okay, I mean, think about the size of the premiums they're paying for all their property, for all their equipment.
Must be a lot of money.
It must be a lot, probably in the millions or billions, perhaps.
Yes.
Okay, so now, could you save millions and billions? Yes, you could, by creating a captive.
Captive.
Right. All those premiums you're paying to third-party insurers can be kept within the business. And that's how a captive is a benefit. And if the company is too small and they can't afford to create a captive, they can still utilize a different company's captive because now it's creating how can I say, a benefit for the business because they don't have all the pain or the admin or the red tape of having to create this business, but they can still enjoy all the benefits.
Yeah.
Right, so advantages here, recapturing profit and investment income, greater flexibility, costs are lower, greater returns, no need to invest, okay, faster execution. Right, similar examples to the one, or similar benefits rather, than we saw in the previous one. Okay. Alright, Melanie, sure, we've finally reached the last one. Okay, study unit 17, which is finite risk insurance and capital market instruments. Okay, this is the last chapter looking at other products. Okay, finite risk insurance and capital market instruments. That's what this last chapter is looking at. Okay, so no more self-insurance. This is just other considerations. Okay, right, 2 questions. The first one, is complete self-insurance possible, Melanie?
Yes.
complete self-insurance.
No, not complete.
Yeah, we can't self-insure everything. Do you agree?
Yes.
Okay, as much as we want to. So you mentioned you're quite conservative as in terms of risk. You always want to have peace of mind. Okay, so if that's the case, why don't you cover everything? It's not possible. Why?
I think in terms of regulation, maybe not everything can be covered.
Okay, possibly, yes. So certain things can't be in terms of legislation. Okay, that's fine. That's one consideration. But is it also, if we think about the resources, do companies have resources to completely cover everything?
No.
No. Okay, so self-insurance is a very expensive exercise. Okay, it's expensive to do, and if you want to create a captive, it's even more expensive to do.
Yeah.
Right, so is it possible to combine insurance and self-insurance?
I think it is.
It is possible to combine both. Okay, where you have insurance, but you're also looking at self-insurance. Okay, so finite risk insurance is, what is it? Here's the definition, okay, characteristics. Okay, insurers have limited finite risk assumption. What does that mean?
There's limits.
There's a limit to the
risk.
The risk that they take on or the loss that they have to pay for. Do you agree?
Yeah.
So do you still have peace of mind as the insured?
No, because of the limits.
Do you still have insurance?
No, because of the limits. Yeah.
Yes, you do. Okay, but that is limited in terms of the risk assumption. Okay,
yes.
So the insured is responsible for excessive losses above a limit. Okay, above a limit means if I've exceeded a certain amount, then I'm going to get a payout. Not payout, excessive.
You have to pay.
Excessive. Right, so this is the opposite. Okay, so the insured is responsible for excessive losses, and the insurer is responsible for those day-to-day. Does that make sense?
Yes.
Okay, so you take out day-to-day cover, okay, finite risk insurance for a limited amount, and then you're comfortable exceeding loss and paying for the excess.
Okay.
Okay, so so you have insurance for, okay, so let me put it this way. Let's imagine this. Imagine you could take out car insurance where you're only going to get paid out for those massive damages, okay? But then the small scratches, you pay for that yourself.
Yeah.
Okay, that's the one scenario. The other scenario is the small little scratches and stuff is covered by the insurance company because those happen often. Do you agree?
Yes.
But the major accidents aren't, and that's what you would then cover as the insured.
Okay.
Okay, so two scenarios. Either one scenario where you're covering all the big losses and the insurer's covering the small losses, or the insurer's covering the big losses and you're covering the small losses. Okay, or the other way around. Okay, big losses are covered by you and small losses covered by the insurer.
Okay.
Okay, so it's just either or. It's a different way of looking at it. Okay, this is combining insurance and self-insurance. Finite insurance is a multi-year contract, and there's a greater aggregate limit of cover. Yeah, and these are some of the different things that you can get. Okay, you can get a loss portfolio transfer, you can get an adverse development cover, and you can get a finite quota share. Okay, the one is looking at ceding future payment obligations based on past underwriting. Number 2 is the cover for cedents for losses. And number 3 is protective cover for current and future business. Okay, these are very specific. I haven't seen them come up in any of the past papers yet. I think it's just too specific. It's too technical. Okay, there's a lot of other things that they do focus on. Okay, and that's why the past papers give you a good guide in terms of which sections are more important. Okay, I would stick to the past papers as a guide in terms of sections that are popular from an examiner point of view. Okay.
Okay.
Right, we've got 3 more here. Spread loss treaties, spreading risk over time to better manage timing risk and smoothing fluctuations. Okay, you're spreading it out. Guaranteed cost approach, where there's a fixed premium and it's guaranteed with possible adjustments, so that could or can't change, it depends. Okay, because remember, is insurance automatically renewable?
No, you have to.
You have to renew it and you have to apply for it.
Yeah.
Okay, it's a negotiation process that needs to go through. Okay, retrospectively rated programs, a formula which is adjusted retrospectively. Okay, and I think that's it. Yeah, and then the last bit over here is a note about capital market instruments. Okay, so have you ever heard of some of these things? Catastrophe bonds.
No.
Insurance derivatives.
No.
Catastrophe risk exchange. Okay, so all of these are fancy products that the banks and the insurers create to help with generating a return for investors, and also to create a product for people wanting to take out those items. Okay, so did I write that on the next page? No, I didn't. Oh, I was supposed to search for it. I have searched for the other thing. I didn't search for this. Okay, did you know you actually get weather derivatives?
No.
Okay, so these are products that are based on the weather. So if the weather is good or bad.
Sure.
Okay, and these are products that are bought and sold in the market. Something else that's bought and sold in the market is a catastrophe insurance product, a catastrophe bond. Okay, assets linked to insured risks. Okay, so how about this, Melanie? Okay, so that's the end of the notes. I want to quickly show you an example of a catastrophe bond. Okay, do you still remember who Warren Buffett is?
I remember the name.
Yes. Okay, Warren Buffett is a very famous investor. Okay, and he has spoken about catastrophe bonds not long ago. Okay, let's first understand what a catastrophe bond is. Okay, so here's the definition according to Investopedia. Okay, a catastrophe bond is a high-yield debt instrument that is usually insurance-linked and meant to raise money in case of a catastrophe such as a hurricane or an earthquake. How about that, Melanie?
My word.
Okay, you're raising money in the event of a catastrophe like a hurricane or an earthquake. Right, so someone actually gets paid out when there's a hurricane or an earthquake, because these are insurance instruments, okay, that are based on an event that can or can't occur.
Wow.
Okay, interesting, hey?
Yes.
Right, so let's have a look at what Buffett said. Okay, why Buffett is steering clear of catastrophe bonds. Okay, Buffett is an investor. Buffett invests in companies like Coca-Cola and other big worldwide companies. Right, so I want to show you this here at the bottom. Okay, let me ask you this first. How much money do you think is being spent on products like these, catastrophe bonds?
Millions?
Okay, a few million. Okay, let's have a look. So from the Financial Times, there was an article here about it. Let me show you this. Okay, investors and central bankers alike should take note. A casual observer might assume Mr. Buffett's move has arisen because natural disasters are becoming more unpredictable. After all, just this week, the White House released a report blaming climate change for the more extreme heat, fires, and torrential rain. Okay, so do you agree? This particular product is relating to an event, and what is the event? It's a natural disaster, hurricane, earthquake, or other. Okay, have a look at this. Where is the note about it?
The 20 billion.
It's over here.
I think it's further up.
Was it further up? 20 billion.
20 billion.
Where you see 20 billion?
Okay, wait, you're going up too fast.
Let me quickly check here. There was a note that I saw.
There's the...
Oh, here's it. Here. Yeah, you got it. There's it there, Melanie. You're right.
Yeah.
Okay, have a look at this. It's a $20 billion market. Not millions. We're talking billions.
My word.
And that's dollars. Okay, have a look. It's a $20 billion market for catastrophe bonds or cat bonds. Okay, have a look at what happens here. These instruments, which first cropped up 2 decades ago, essentially enable investors to bet on whether insurance companies will face claims from businesses affected by large-scale disasters, or whether the businesses themselves will suffer losses. They are typically issued for 3 years, and if no disaster occurs in that period, bond investors receive a good payment. Otherwise, they have to pay out themselves. Okay, so what happens? So the investor is betting that there isn't going to be a natural disaster. Do you agree?
Yes.
If there is a natural disaster, then the investors have to pay for those damages.
Yes.
Okay, the insurer, what does the insurer want? The insurer wants the natural disaster to occur because then they get paid out.
Yes.
Okay, and then where was the note over here? Okay, here. Right, in the past couple of years, it has swelled dramatically. However, with the record of $4.5 billion issued in the first 4 months alone. Okay, mainstream investors have jumped in because how often do you think these things are going to occur, natural disasters?
It's unpredictable.
It's unpredictable, exactly. No one knows. Okay, but remember, in the insurance industry, we can create a product for the uncertainty of something that doesn't or does occur.
Yeah.
Okay, and that's why you get things like weather derivatives. Let me see if I can find that quickly. Weather derivatives. Okay, there we go. A weather derivative is a financial instrument that can be used by organizations or individuals as part of a risk management strategy to reduce risk associated with adverse or unexpected weather conditions. Okay, so you can buy a product. So if the sun doesn't shine tomorrow, we're going to get a payout. Okay, if it rains tomorrow, we'll get a payout.
Yeah.
Do you see how crazy that is?
Yes.
Okay, but it happens because remember, in the financial market, you're creating a product to try to prevent uncertainty. Okay, so you could have weather derivatives, you could have catastrophe bonds, you could have almost any product. Alright, so a payout is made when an event occurs.
Okay,
yeah, it's quite interesting. Alright, so that was something that I found when we covered this topic some time ago. Okay, right, Melly, and now we've eventually covered all the theory. Happy?
Yes.